In this video, I want to talk about two value stocks to buy now. I believe they are pretty good buys at the moment. The stocks are down and they have a lot of potential to outperform the market in the future. The two stocks we are going to talk about today are one, Crocs, okay, the shoe company, and the second one is Alpha Metallurgical Resources. It's a coal play. Full disclosure, I own AMR. I'm bullish on AMR. I have personally invested in this stock, and actually I am eyeing Crocs. I'm thinking of opening a position to Crocs. I believe this is very interesting, very cheap at the moment, and you have a lot of potential. Okay, I think we can start, and you will talk about fundamental analysis, what the trend is for these two companies, what are the potential catalysts to this company. We'll go into much depth for AMR, the coal industry, the trends for 2026, and the guidance, because we just had some updated information when it comes to this company. Okay, in case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in value stocks, investing in quality companies. Today I want to talk about value stocks, but this is not the only thing I do with my portfolio, right? And the goal is to outperform the market, right? The goal is to find opportunities that can generate 20% per year. Okay, first one, I want to talk about Crocs. In case you don't know Crocs, maybe you know the company, but you don't know maybe you know the shoes, but you don't know the company very well. They have a very simple product of these big shoes, and let me just show you this kind of shoes they have, but I think everybody knows the kind of shoes they have. Very simple, plastic, and this is it. This is the end of the business model. It turns out that they made an acquisition a couple of years ago for Hey Jude, and it was financed by debt in 2022, and the acquisition was not that good. Let's say the least. It's a small company, market cap of $4 billion. It's a cyclical company, like all the shoes, apparel brands, and the stock has been on a run. When they made their acquisitions, it was here in 2022. After COVID, the stock went up a lot from $20, let's say $20, to $170. The stock was loved, and then the stock completely dropped from $170 to $50. And since then, you had a couple of fluctuations. My guess is now the stock is down, the sentiment is bad, people are bearish, they cut their guidance, the expectations are low, people see that their acquisitions of Hey Jude in 2022 was not great, but they are very well aware of this. So they will take advantage of the volatility and improve their core operations. Now, let me show you the fundamentals of the business. We are talking about a company that improved drastically since 2020. This is the revenue in blue you have here, and a strong improvement since 2020, since COVID. And now you have a new base of new revenue, okay? Very stable here. You don't have a growth that is reverting back. What about the net income? Similarly, before COVID, it was a little bit of a mess. The company was struggling to be profitable. And since 2018, 2019, 2020, everything changed, right? We are talking about a sustainably profitable business model. You see the change before COVID, after COVID. What about the cash flows? Same thing. All the cash flows are converted. All the net income, all the profits are converted into free cash flow. You see this line here? Let me show you. The net income in green and the free cash flow in blue. Almost the same thing. Okay, you don't have much capex. You have very minimal capex for this company. So every revenue growth the company has is translated into net income, into profits, instantly translated into free cash flow. What is the company doing with the free cash flows? They are doing buybacks. Look at this. For the past 10 years, you see green charts here, green candles. They mean buybacks. Every time they generated some strong cash flows, they were doing buybacks. In 2021, they repurchased 11% of their shares. During COVID, 3% of their shares. Last year, 6% of their shares. In 2023, 2% of their shares. They made an acquisition in 2022 with debt, as you can see here, with also shares that were richly priced at the time of the acquisition. So it makes sense to just dilute the shareholders a little bit. The company is famous for doing buybacks, right? This is in their philosophy, in their mindset. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. I don't think they have a lot of risk when it comes to the buyback management, the cash management. You can feel a little bit worried when you look at the balance sheets, and I completely understand. If you look at this, the cash balance over time, pretty stable, and the debt balance over time. At the time, it was a company without any debt 10 years ago, and now more debt and more debt to fuel some growth. So massive debt in 2022, more than $2 billion, and it is slightly trending down. So now what did they do since the Hey Dude acquisition? Actually, Hey Dude acquisition, the Hey Dude brand now represents 20% of the revenue for Crocs. So not that important actually. The Crocs brand, the core operations, what is profitable, what is thriving, what is succeeding is 80% of the revenue. I don't understand why people are so bearish about the Hey Dude acquisition. Maybe it's a fiasco. Maybe it doesn't work at all. Maybe the margins are bad, but it only represents 20% of the revenue. They can go to 10% of the revenue. It doesn't matter much, okay? So actually, the cash flows the company had were used to buy back more shares, to pay off the debt. And in a couple of years, in a couple of quarters, in a couple of months, they will have stabilized the debt problem, meaning they will have a normal debt level, net debt to EBITDA, these kind of things. If you look at the latest earnings calls for these companies, you can see that they are pretty comfortable with their debt level. They are almost at a threshold where they will not pay off the debt anymore. They will stop paying off their debt because they are at a reasonable level. You see, in the past 2022, most of the cash flows were used to buy back some debt. Now it's a little bit more stabilized, I would say. You see, in 2022, this red line was going down and down and down, and now it's more stable. Same thing for the buyback. You see here in 2022, no cash was used to do buybacks. And now more and more cash are used to do buybacks. So actually, the capital allocation strategy for this business is very straightforward. Very simple, and I like it. Now, you may tell me, Chris, do you see now that they are becoming unprofitable? Look at this line in net income. That's down. Well, that's a write-off. That's an accounting change because they literally said, our Hey Dude acquisition is bad. So let me write this off. It's an accounting change. It has no impact at all on the free cash flow. If you look at the free cash flow over time, no change. It's not down, right? So it's only an accounting change. Please don't mind this, which means the earnings need to be adjusted for this quarter, which means the PE ratio is wrong. Okay, so we will only look at the valuation multiples regarding cash flows. We will not look at the earnings ratios because of this, because of the big adjustment. They said publicly, yeah, let me write this off. It's pretty bad. Let me show you what I mean. Oh no, this is for Crocs. This is the financials. Let me show you the KPIs. I said before that the Hey Dude acquisition represented 20% of the revenue. Let me show proof of what I say. Hey Dude and Crocs. This is the revenue over time. Very well. You have the split. In orange, that's the revenue coming from the Crocs brand. In blue, Hey Dude. When they acquired Hey Dude, it was 25% of the revenue. But because the growth is so bad, it has declined. On a quarterly basis, what do we have? Do we have the data? Yeah, declining to 16%. Yeah, I think the company as a whole, Crocs, wants to focus on their core operations and Crocs, and it is working right now, especially internationally. It is working. Okay, what else can I show you on the KPIs? Yeah, they sell their shoes a little bit everywhere on every continent. And you have the footwear unit sales. Yeah, nothing really relevant to the thesis. Actually, the geographical split will not make much of a difference. Internationally, they are quite profitable. Internationally, in Asia, they are growing massively, I would say. And if you look at the valuation for Crocs, look at the price to free cash flow. We are at almost a 10-year low. Almost a 10-year low. We are at a very low valuation. Let me remove this in 2016. I mean, just look at this. We are the lowest valuation for the price to free cash flow, even below the COVID levels. Maybe this is warranted because the company is expecting bad stuff. Well, what is priced in by the market? What is priced in? You can click on estimates here. I'm on Fiscal AI, by the way. This is a great website, one of the best investing websites you can have. And you can use my link in the description of this video to have a discount code, a promotion. It will get 15% cheaper. So you can try it out for 2 weeks completely for free. And if you like it, you keep it. And if you use my link, it's cheaper for you. So please use my link. It's a win-win for everybody. What is expected for Crocs? Sorry. The revenue for Crocs is expected to be flat, almost flat. Look at this. For 2026, they expect the company to grow revenue by 1%. And for 2027, by 1%. What about for earnings per share? What is expected for this company? Flat, flat. What about the free cash flows for this company? A little bit of growth and a little bit of a decline. So flat, flat. Not a lot of things are priced in when it comes to Crocs. By the way, you can check what Wall Street thinks the price targets are for this company. As the stock is dropping, as always, Wall Street is late and Wall Street is adjusting their price targets after the movie. You see this big decline of Crocs recently on a year-to-date performance. One day, the stock dropped 30% in one day because of this write-off. They publicly said, you know what, our acquisition target was quite bad. Let me write this off. Accounting change, bad earnings. We will cut our guidance a little bit. We'll cut the margin guidance a little bit. We expect not a strong 2025. So the market dropped 30%. The stock dropped 30% in one day. Okay. And the stock is not rebounding. This is the reason why I am personally interested in buying. The stock has rebounded a little bit and back down. So this is where value investing shines. When you have a business model that is accused of being very bad, that is accused of being in danger, bad acquisition, bad business model, many risks, no growth, but the business is fine. Because now you are talking about a company without much growth ahead, okay? But at the same time, this is a company that can generate massive cash flows, okay? If you look at the operating cash flows, we are talking about what? $1 billion of free cash flow, operating cash flow generation. I mean, operating cash flow, free cash flow, that's almost the same. $800 million of free cash flow generation, okay. What is the market cap of this one? $4 billion. So, I mean, to be bullish, let's say they can generate roughly $1 billion of free cash flow. Maybe a little bit less, but you will get my point. Anyway, let's say this is a company that can sustainably create $1 billion in free cash flow every year. Okay? Wall Street is expecting less than this. Okay? But even if you are pessimistic on the free cash flow side, you are fine. You are fine. This is a company that publicly announced they are fine with their debt level. So maybe they will not pay off their debt completely. They will pay it off a little bit and then stop the debt problem. All the cash will be used to do buybacks. So now we can check. Will the company use the buyback to do, use the cash to do some buybacks? Well, actually, we can check if in the past, when the stock was valued cheaply, if they increased the buyback level. Okay? What do we have here? In blue, you have the price to free cash flow. I mean, come on. In 2020, you had a price to free cash flow of 40. In 2020, of 80. In 2021, you had what? 20. The price to free cash flow went from 20 to 5 now. Now, let me take into account the debt. Let me check the EV to free cash flow. Fair enough. This is your EV to free cash flow over time. 16. Let me arrange this a little bit so you see better. Okay. When the company was trading cheaply in 2022 with the EV to free cash flow, EV meaning enterprise value, so you just add the debt back. You take into account the balance sheet of the company. So when the valuation dropped from a EV to free cash flow of 25 to 10, the company increased the buyback level. Before they were buying back 7% of their shares, and it went up to buying back 25% of their shares if they continue at this rate. And then the valuation rebounded. They stopped the buyback program. And focused on the acquisition actually and the debt repayment, as we said previously. And now, as they are more comfortable with their debt levels, now the stock is getting cheaper. The valuation went from 14 to 7 here. And what did the company do? They continued to do buybacks from a buyback yield of 4% to 5% to 6% to now 10, 12, 13%. Okay? So the company is not, if you take into account the debt, the company is not at the lowest valuation ever, I think. Let me check. Or maybe yes, because the stock dropped again. Let me check here. Yeah, we are almost at the lowest valuation ever for the past 5 years. The lowest valuation, it was in February 7. Now we're at 7.5. I mean, come on, we are talking about peanuts here. If you look at the company, you never have these kind of ratios. We never have this kind of valuation. It's very rare. So, a lot of pessimism. People are not liking the brand. People say a failed acquisition is a sign of a weak management team. But now the company is very cheap. EV to free cash flow of 7. Price to free cash flow of 5 or 6. If you have no growth in the future, free cash flow can stabilize and all the cash will be used to do buybacks. Well, fine to me. If they can repurchase 10% of their shares every year, that's a 10% yield for us shareholders. So it is great. I don't believe the company, they don't pay a dividend, so everything is flexible. They can use all their cash to do buybacks. This is pretty good. Let me show you the graph of free cash flows for this company. Free cash flow is here. Now, even if you assume a decline in free cash flow, this is fine. Let me show you what I mean. On the last 12 months basis, what has been the free cash flow for this company? Even if you expect if you expect $1 billion of free cash flow every year, this is extremely good to buy right now. The company is extremely cheap. Now, if you expect the free cash flow to decline a little bit, what can you see? Strangely enough, Fiscal AI is having a small problem here. Anyway, that's fine to me. I will check on Google Focus. Or maybe that's my Wi-Fi. I'm having some Wi-Fi difficulties today. Anyway, if you look on Google Focus, the free cash flow, you can see that it is trending down a little bit. $800 million, $700 million. The bull case, the bull thesis is exactly the same. You have a company that will use the majority of its free cash flow to repurchase shares. Okay, anyway, I think that's a Wi-Fi problem on my end. Let me check if I can do it again for free cash flow on the last 12 months basis, and it is now working. Fair enough. Yeah, you have a company that is generating huge free cash flows, and most probably, as the tone of the management indicates, they will stop the repayment of the debt soon and allocate everything towards share buybacks. This is how I see the situation. And if this is what actually happens, the stock is extremely cheap and the stock is a buy right now. So this was my thesis about Crocs. I will let you know if I buy. I will let you know when you buy, when I buy. And pretty interesting, typical value play, a lot of pessimism, very cheap. Okay. Also, what can boost the growth for this business and what can allow the business to have a free cash flow of $1 billion to increase their core operations of the Crocs brand are advertising, promotions, and everybody who is talking about Sydney Sweeney right now. So Sydney Sweeney is having a partnership with Hey Dude. Every time Sydney Sweeney is partnering up with a brand, it's very good news for the brand. Let's call it this way. And now they are focusing on increasing the revenue, being a growth company again, not being stable but growing again. Well, you have a clear partnership with the Sydney Sweeney. The last time Sydney Sweeney made an ad for a company, it was extremely bullish for sales for this company. It was AEO, American Eagles Outfitters. And since then, the company, this was their latest report, and they said they never had this kind of sales because of the Sydney Sweeney ad. The best ad they've had in years. And during the report, the stock was up like 30% in one day. Very interesting to see this kind of turnaround play just because of one ad. I'm not saying it will change the thesis for Crocs. I'm saying it will maybe save the day for Hey Dude for a couple of quarters. And if this ad is relevant and is now working, Hey Dude will appear stronger and the multiple for Crocs will expand. The PE ratio will go up, meaning the price to free cash flow will go up for Crocs. This is all about sentiment, right? The price to free cash flow at this point, because it's all about sentiment and being pessimistic and bearish, you just need a price to free cash flow increase and you're fine. Price to free cash flow here. A couple of years ago, 2 years ago, you had the price to free cash flow of 10. You go from 5 to 10, that's a double. So very easy for the sentiment to change. And actually, one super investor is bullish Crocs. Norbert Lou from Punch Card Management, one of the best value investors you can have right now. He doesn't trade a lot. He doesn't have a lot of turnover. But when he buys big. And most of the time, he's right. And very recently, in the latest quarter, Norbert Lou bought PayPal, 15% of his portfolio, and Crocs, 17% of his portfolio. So if one of the best value investors in the world is buying Crocs, at the same time, I have my pitch that I just told you, low valuation, the business is fine, they will focus on core operations. What does that tell you? It increases my bullishness. By the way, I applied for an internship for Norbert Lou from Punch Card Management a couple of years ago, and I've read all the information available from this super investor, and he is great and performing very nicely, I would say. The philosophy is great. Not a lot of buys, not a lot of sales. You buy and you hold and you compound, and it works. And you have a concentrated portfolio of a few stocks. But if you pick them wisely, you outperform the market. And Norbert Lou has been outperforming the market for many years now. So maybe him buying Crocs is the ultimate buy signal you needed if you are hesitating right now for Crocs. The company is very cheap. They will use most of their cash flows to do buybacks now. And Norbert Lou is buying. It's extremely bullish, actually. It's extremely bullish. Okay, so that was for Crocs. That was for the first pick. The second one is Alpha Metallurgical Resources, a met coal company. Okay, so you have two kind of coals. Let me do a quick recap of the industry for those who don't know this industry. For the coal mines, the coal industry, you have two kind of coals. The thermal coal that is used as an energy component, and the met coal, metallurgical coal, that is used for creating steel. So bridges, roads, this kind of stuff. And you need more infrastructure in this world. You need more steel in this world. So you need more met coal. And AMR is only focused on met coal. It's a US based company. Market cap is $2 billion. And the stock is very cyclical. Very cyclical. Actually, Monish Pabrai is invested in this one and other met coal players. But this is a pick that he knows very well. He discussed with the management team, and if you had invested in this one a couple of years ago, you would have been very rich today. Okay, so The stock peaked in 2023, 2024 because it follows the raw materials prices. Let me show you what I mean. If you want to track the met coal prices, you can check this in case you want to continue your research after this video. Let me give you all the quick tools. API to coal, this one, and you just track this, and you can see that it peaked in 2022. And the way AMR is working is you lock the contract with the volume and the pricing. So you have a little bit of a delay between the peak of the commodity price and the peak of the stock price because of sentiment and guidance. Okay, so we are talking about a company that is hated. It's about coal. It's not a sexy industry at all. They have different margins, changing margins. And if you look at the revenue, it's growing a little bit, decelerating. Net income, it's a complete mess. Free cash flow, it's a complete mess. And now this is changing. Meaning, in the past, before 2021, the company was net debt. And when this commodity price peaked, they made a lot of free cash flow, a lot of profits. They used all their free cash flow to do what? To reinvest in the business? No. To repay their debt. So they paid off all the debt. Boom. You don't have any risks when it comes to the debt level. You are not now a net cash company. Fair enough. So safe company. You can't go bankrupt if you don't have any debt. Secondly, what did they do with the cash when times were easy? They used the cash to do buybacks. In 2022, they bought back 16% of their shares. Huge buyback. In 2023, they bought back 17% of their shares. Huge buyback program. Like in 2 years, you buy back more than 30% of your shares. That's phenomenal. And now the commodity price went down, stabilizing a little bit, higher than in the past, but still down from the peak. The whole industry is in a downtrend. Revenue is trending down. The company becomes unprofitable. But for the past few quarters, the company was not doing any buybacks. Like they stopped and went into defense because of the cyclicality of the industry. And I have read all the transcripts, all the conference calls, all the interviews, all the Monish Pabrais interviews, by the way, with great value. And I have followed management very closely. And I've never seen such a management team that was so focused on buybacks and improving the earnings per share, free cash flow per share. So now that times are difficult, times are hard, they focus on defense and they wait for a turnaround in the commodity price. In the meantime, what did they do? They stopped the buybacks. They kept their cash. They did not go into the debt market. They just used their cash. And for a few quarters, you play defense. You keep your liquidity to yourself. Because when the cycle turns again, you will print cash. You will tap into your cash reserves to do as much buybacks as possible. Guess what? In the latest quarter, let me remove this. In the latest quarter for this company, seems like the management changed their tone. In the latest quarter, so that was one in August 2025, let me put full screen so you see better. They announced results and they announced a lot of efficiency, liquidity, blah, 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 because they lowered their guidance for costs. Lowers 2025 cost of coal sales guidance. And at the same time, you reduce your SG&A guidance. So again, you reduce your cost. At the same time, you increase your income guidance. So this is a company that is very cyclical. Management knows it very well. This quarter, they did something very strange, very special that happened very few times in the past. They say clearly, we increase our net income guidance for the remaining part of the year. At the same time, we reduce the cost guidance, which means you will create a gap. More profits, less costs, which means a much bigger cash flow generation. So they completely raised the full year guidance for the cash flows for this year. The only thing that is changing and that is quite bad for this report is the full year guidance for operation expenses that was raised. Okay, so you have maybe 3 good things, 1 bad thing. No, this is not a perfect report, but the tone is changing. This is what I'm trying to say. Because at the same time, let me pull full screen so you see better. If you scroll down, yeah, this is a commentary from the CEO, very well. At the same time, they changed their capital allocation policy. Totem debt, where is it? Share repurchase. Okay, here you go. As previously announced, the board of directors authorized a new buyback program. So you can repurchase the buyback program for $400 million. Due to softness in the markets over approximately the last 5 quarters, the company has refrained from doing buybacks, electing instead to focus on strengthening its liquidity position. They want to play safe, they wanted to play defense. Having achieved a meaningful increase in liquidity over that time period, as I showed you before, the company plans to restart the share repurchase program on an opportunistic basis. The timing and amount of the share buyback will depend on if we'll want it or not. But actually, the company literally is saying publicly that we were playing defense, but now we see a turnaround. So we reduce the guidance for costs, we increase the guidance for revenue, we see a turnaround across the corner, so we increase our guidance. And at the same time, they literally said we were playing defense. We will now use our cash flows to start buybacks again. And they are right. I mean, if you look at this chart, they were not doing any buybacks for months and months and months, quarters and quarters and quarters, and they will now start again. How bullish do you want the company to be? If you follow turnaround plays, commodity cycles, how bullish do you want to be? Well, the management is clearly telling you what will happen. So if now, when? Maybe they are wrong. Maybe this is not the turnaround that everybody expects. Maybe the commodity price will continue to go down. Maybe they are not perfect. They don't have a magic crystal ball. But apparently this is the turnaround play. If this is a turnaround, well, you will have seen the signs. But anyway, what if they're wrong? And now I want to show you some things that are pretty good. What if they are wrong and it is not the turnaround play and it is not the absolute bottom for the stock? Well, let's look at the free cash flow. You are talking about a company with this kind of free cash flow. Let me show you the financials of the company. Let me show you the cash flow statements. Let me show you the free cash flow over time. This is a company that has a free cash flow that is widely fluctuating. Okay? For the past 10 years, this is your free cash flow. So up a little bit, flat, a little bit down, but let's say it's flat. And then when it booms by $1 billion of free cash flow generation. And then you go back down. So let me put more granularity, more details so you see better. This is what you have. In 2020, the world was shutting down. So negative free cash flow. And then everything reopened again. And they generated more than $1 billion in free cash flow. Now that we have a downgrade, the industry is down, well, they don't produce much cash flow, but they don't lose money at the same time. They produce flat cash flows. So when times are good, the company can generate a substantial amount of free cash flows. When times are bad, you are flat. Talk about a risk-reward perspective, right? So heads, I win. Tails, I don't lose much. It's not as if the company was printing cash flows when things were good and destroying cash flows and burning cash flows when things are bad. No, actually, it's either you are up a lot or you are flat. Now, the industry has been struggling for many quarters now, and they didn't burn cash. If you look at the balance sheet for this company, they are not increasing the cash flow levels, but they are stable. It's literally the definition of heads I win, tails I don't lose much. This is why Monish Pabrai is invested in AMR. And I am personally invested in AMR because of this risk-reward ratio. So you have this situation, this risk-reward perspective. At the same time, the management is bullish. At the same time, the management is doing buybacks again. Well, the stock is up. They announced the buyback program again with this report, and the stock jumped, and now it is trending up. So maybe $100 for the stock was the bottom in June 2025. We are already up 60% from the low. Maybe this is only the beginning. And if the cycle turns, when the cycle turns, the stock can go back to 200, 300, 400, or maybe more. So Alpha Metallurgical Resources is a great value play right now. I believe the stock is a buy right now because of everything I've said before. With the risk reward, the tone of the management, they will do buybacks again. The company is quite cheap and they can continue to reward shareholders with these buybacks. We are talking about a price to free cash flow of 12 with low free cash flow, right? So you can have a reversal of the trend that will happen eventually and the stock will go back to 400. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.